Good morning, everybody. Thank you for joining us for this latest episode of Coffee with Bob. We're really excited to bring this episode to you guys today. I see some first timers on here. So for those of you who are tuning in for the first time, thanks so much for joining us. We're happy to have you. And for those of you who have tuned into many episodes before, thank you for continuing to support this. We're going to be bringing more great content your way for the rest of this year, moving into next year as well. I am your host for today, Christina. Coffee with Bob, for those of you who are tuning in for the first time, is a mini webinar series brought to you every other Wednesday where we cover timely topics that are relevant to you. Please pass the word along about Coffee with Bob. We're trying to grow it. We want to continue bringing this to you guys. A lot of fun topics coming your way. So please pass this along to anybody who may be interested in topics covered previously, or, as you get emails promoting new episodes, feel free to pass them along. The more the merrier. We have our cups of coffee. We hope you guys do as well. Or tea, water, like I always say, any sort of hydration enthusiasts are in good company here. Okay, so let's jump into this conversation. Quarterly market and economic update. It's a quarterly update that we are going to plan on bringing to you guys again every quarter as new information about the economy is released to us, and we will be deciphering it from our perspective, from our point of view. Before we actually do that though, I just wanted to make sure everybody is aware we have a YouTube channel now, and that YouTube channel features all past episodes of Coffee with Bob. It also features some other retirement, topics as well. And then as we broadcast new episodes of Coffee with Bob, we will be uploading those to the YouTube channel as well. So please do check that out. You can just Google Hapanowitz and Associates YouTube. It's very easy to find, and you can view at your leisure. So how far have we come since March? What progress has our economy made? That's the question that everybody is asking these days. And that's the question that we're going to attempt to answer for you guys today, again, from our perspective, at least. And we're going to do that in a couple ways. So first thing we're going to do is look back on that time, especially second quarter data, right after the drop in the S&P and when things really started to get bad in the economy. When the shutdown first happened. We're going to take a look back at what that looked like. We're going to take a look at the more recent data that's been released to us, that's starting to be released to us for the third quarter of this year. And then we're going to try to put that all into perspective in terms of how we should be moving forward for the rest of this year and even into next year as well. So Bernard Carter, Bobby Hapanowitz, should have introduced you guys first. Bernie is a CFA and a CFP. He's a wealth advisor. He is our managing director of investments at H&A. Bobby Hapanowitz, also a wealth advisor, and helps head up our investment committee here at H&A as well. They were here for the last quarterly update. They're here for today's quarterly update, and they'll be back with us for the quarterly updates to come. So thank you both again for joining us today. And let's dive into it. So Bernie, I'm going to turn it over to you. Talk us through that second quarter. I know this is information that we did cover during the last economic update. So let's talk through this again.
Thanks, Chris, and good morning to everyone. Thank you for being with us today. We really enjoy these market update coffees with Bob, so we're happy to have you with us, and let's launch into it. So, Chris, you're right. As we always do, we generally like to start the market updates with a look back to where we were the last time we spoke. And the last time we spoke was in early July, right after the second quarter had concluded. And at that time, we knew that we had had a rough period in the second quarter from the economy standpoint, but the data wasn't complete. It wasn't in yet. Well, now that we're several months ahead, we do have the data from the second quarter, and we posted a couple of those data points on this slide. And you can see that it was an ugly quarter from an economic standpoint. um, all of the traditional measures, gross domestic product, consumer spending, business investment, all of these data points plummeted second quarter. Unemployment, another important statistic, it rose to a record high during the second quarter. So not a pretty picture. However, the most exciting, I think, and the most interesting part of the second quarter was, despite all of this negative news, all of this bad news, the market rose substantially. The S&P 500 was up over 20%. Small stocks in the United States were up even more. They were up 25%. And oil prices almost doubled during the quarter. So this was yet another reminder that markets are usually forward-looking. They don't do business in the rearview mirror. They do business through the windshield. So the market took the more optimistic picture that it saw in the future, and it brought that data into the prices of the second quarter, and that's why we had such a outstanding recovery in the stock market.
Yeah, I think it's also a testament to our supply chain in our country. Our supply chain, I think, is an easy thing for a lot of us to take for granted, but it didn't break down. It just adapted. Maybe the exception is toilet paper for a little bit, but it was a true test of, our supply chain, our processes. And I think that's something that we can all be, really feel really secure with. On here, we talk about oil prices and, such a steep increase in oil prices. Now, the markets, the S&P, the NASDAQ, the Dow, those are benchmarks that I think are very obvious benchmarks for many people to follow, because when you turn on the news, that's what you hear is the S&P, the Dow. But talk us through oil prices, Bernie, and why they are such a significant factor when measuring the economic recovery.
Good question, Chris. So oil tends to be a barometer for the economy because demand for oil increases when economic activity increases. So if manufacturing is occurring, if transportation of goods is occurring, if spending is occurring on travel, both business travel and pleasure travel, all of these things consume fuel, they consume oil. So the price of oil tends to go up when the economy is doing well. So that has been impacted somewhat recently on the supply side, particularly in the US, where we've sort of leapt to the forefront as a global producer of oil because of advances in technology. So oil as a barometer for economic health isn't quite as sharp as it once was, but it is still considered a good barometer to turn to measure the health of the economy.
Okay, yeah, thank you for that. And, also another thing I want to point out on here is consumer spending, as we see on here, declined 31.4% in the second quarter, which is huge. Bernie, how much of our economy does consumer spending represent? And how big of a role did it have in the, quote unquote, downfall of our economy, the downward spiral of our economy? Those are harsh words, but you see what I'm getting at. And also, what role did it play in the recovery of our economy so far?
Yes, another good question. So consumer spending is a big part of our economy. It's a little more than 2/3. So when it changes, it has a very big impact on the economy. And in the downturn we experienced in March, consumers, they turned off the spigot very quickly, and it hit us hard right away. Retail spending, travel spending, spending in restaurants, these data points plummeted. So when consumers stop spending, it has an immediate effect on the economy. Now, conversely, the same is true on the other side. So recognizing this, the federal government injected quite a bit of stimulus into the economy, and much of that was directed at putting money in the bank accounts of households. And so when it did that, I mean, households responded as they normally do. They spent a good portion of those funds. So the consumer spending rebounded dramatically, after the stimulus took effect, and that has had a big impact on our recovery so far. It's a very responsive, tool that the government can use. They know this, and that was a reason why this was such a big part of the stimulus package.
Sure. Okay, thanks, Bernie. So let's move on to third quarter data. Before I do that, something I forgot to mention at the beginning of this episode is we will be taking questions at the end. So if you do have questions that you would like to ask Bobby and Bernie, please submit them through the Q&A box. That's either going to be at the top or bottom of your screen. Please don't use the chat box, use the Q&A box to submit those questions. And we'll be taking those at the end. Okay, so Bobby, I'm going to turn it over to you. Talk us through the third quarter data that we have so far. At least not all of it has been released to us yet. How do you interpret this data?
Right. Well, first I'd say that Bernie did a great job of explaining that markets tend to be forward-looking, and that explains that rally that we saw in the financial markets, the S&P 500 in quarter two, even when that GDP and other economic data didn't look as great. It was looking forward to and expecting good data in the future, positive data in the future, and that started to come to fruition here in the third quarter. You could see, if you recall the number Bernie provided for 2Q GDP data, down 31%, historically poor number. GDP data in quarter three was historically positive. That rally was historically positive. Another very important number is, of course, unemployment that's dropped to about half the level it was at the height of unemployment in quarter two. And that, coupled with all the stimulus that Congress and the Federal Reserve have pumped into the economy, into the hands of consumers, has really increased consumer confidence, especially here in the last month. And as you both, Christina and Bernie, mentioned, that's so important because consumers tend to be the backbone of the U.S. economy. So that's very important. That in part explains the continued rally we've seen in the S&P 500. Oil prices, increases in oil prices have also helped that as well. And in order to continue to get to make steps towards a positive recovery, a long-term recovery, that is going to rely on progress in combating the coronavirus. And we are making progress, and all signs point to a vaccine being available in historic time, in record time. So that would bode well for the economy over the long run.
How would you rate this recovery so far? Is it in fact a V-shaped recovery, as many people are calling it?
That's a great question. And in many ways, the economic data that we have now, it's too early to tell. Having said that, the financial markets, the S&P 500, have experienced a V-shaped recovery, and that would imply that those in the market are predicting a V-shaped recovery in the economy, and which we haven't quite seen in all aspects of economic data yet. And that's actually a good point, Chris. We'd like to share a chart with everybody showing S&P 500 returns year to date. That's that red line there. You could see it in the middle, and all of these other colored lines are returns of the subsectors of the S&P 500. And we think this is an important chart to look at because the question that many folks have been asking is, okay, are the markets detached from reality? Where unemployment is at 8% now, it was as low as 16%, and the markets are moving up. Does that make sense? Well, if you look at the subsector performance, we see technology is leading the way this year. That certainly makes sense in a global pandemic where everybody is forced to work remotely from home. And with the events that we've seen in the energies markets and the oil markets, it does make sense that energy is the laggard this year. So at first glance, when you see that S&P 500 number compared to the economic data, it can look like there's some irrational behavior in the market. But then when you lift up the hood and take a closer look, you do see a lot of what you would expect to see given what America is facing right now.
Yeah, this is such, it's a really neat window into S&P performance, throughout the year, and a view that probably not a lot of people have. They know the overall S&P performance for the year, but not sector by sector. Looking at this, having this detailed view, is this good? Is this bad? I mean, how should we interpret this?
I think it's a positive view. Again, the question has been, are the markets acting irrationally? And then when you take a deeper dive into it, it would appear that they aren't acting as irrationally as many would think that they have been. So,
okay.
Yes.
All right, good stuff. Thanks, Bob. So I want to go back to that V-shaped recovery. It's been outstanding so far. What people are calling a V-shaped recovery. But on the other side of this, we have had many permanent job losses. So not furloughs, not layoffs, but permanent job losses. It's been, a huge number so far, and larger than previous recessions. So is this kind of recovery, is this sustainable with that huge number of permanent job losses?
Oh, good question, Chris. Job losses are always, it's painful. Very painful to see, household incomes get disrupted and families get disrupted because of job losses. And, the job market changes through the economic cycles. And in past downturns, we've seen job losses that were substantial, and some of them were permanent. Now, in this cycle, same as in past cycles, we're seeing what likely are some permanent job losses. For instance, you look at the oil and gas industry. Oil, a little more than a decade ago, was $120 a barrel, and now it's $40 a barrel. So given the economics of that scenario, it's, hard to fathom a situation where jobs aren't going to be lost in that industry. It's just, unfortunately, a fact. However, the flip side to that coin is if you look at some other industries, and I think technology is an example, certain parts of consumer discretionary like Amazon. Amazon is adding tens of thousands of jobs per year. So
right.
You look at those past economic downturns, there were some job losses that were permanent. However, new jobs popped up and replaced those old jobs. Mm-hmm. And it's likely that'll occur today as well in this downturn and subsequent recovery. We're going to have some jobs that go away, but new jobs, take their place, and we'll emerge with an total employment picture that looks, similar to what it did prior to when the downturn started.
Sure.
Right. Yeah, I think those are great points. And I think with the nature of this recession too, given that we've had to literally shut down our economy, a lot of trends that were in the works that we expected to take hold over the course of 10 or 15 years, such as working remotely, working from home, really have taken place over the course of 5 or 6 months. So any displacement in jobs and employment that was expected to happen over that time period was just expedited. And that would, I think that explains a little bit of what we're seeing there too, with that heightened rate of permanent job loss.
Sure. Okay, thank you both for that. Great comments. So let's move forward. Let's take this data, put it all into perspective. There were so many amazing things that have happened in our economy, in our country, in response to the pandemic and in response to the shutdown. At the same time, there are still a lot of obstacles and risks that we need to get through and take into consideration as we move forward within this economic recovery. So let's talk about this. Bernie, I'll turn it over to you. Let's talk about these positives. We have a lot of them listed on the screen here. Which ones stand out most to you?
Yeah, so I mean, we've obviously been through a lot over the past, 8-9 months, and certainly challenges remain. We've covered a lot of ground. We've recovered quite a bit out of the downturn, but challenges remain. However, there's a lot to be optimistic about. There's a lot of positives about where we are today, and we've listed some of those on this slide. But in terms of what stands out to me, in terms of what's been most effective and what we can look to perhaps be most effective in the future is, I mean, you got to look at the federal response, the federal government response. I mean, it has had a direct and very impactful, effect on just pulling us out of the downturn. The stimulus package, the past stimulus package has been very effective. We're hearing from both presidential candidates, and they're embracing additional stimulus. Congress is going to work on additional stimulus, so we're likely to get that. We're likely to get some type of infrastructure package out of the federal government, where money's going to be spent and jobs created on, getting our infrastructure back in shape. And the Federal Reserve has said, we're going to keep interest rates low to keep the grease on the wheels of the economy. So, those aspects have really been helpful in moving us forward and helping us climb out of the hole.
Yeah, you mentioned stimulus, and it was historic. It was historic in the amount of stimulus made available to us, but also in how quickly it was made available to us, which is fantastic. On the other side of things, a lot of people are concerned or are asking the question, where is this going to leave our future generations and our future economy? How are we going to pay for this? Do you want to speak to that at all, Bernie?
Yeah, that is a really, really tough issue, Chris. And the honest answer is, neither political party has had the will in recent years to stare down this difficult issue. I mean, the matter is we're not paying our bills. Our budget is not balanced. We're spending more than we take in, and our debt is growing year after year. Now, you can make the argument, and I think it's a very strong argument, that today is not the day to make that the priority. We're facing emergency conditions in the economy, and we need to do what's necessary to address that. But however, this issue is going to need to be reckoned with at some point. And it likely, the kind of the juicing of the economy that we're getting today from stimulus, there's definitely somewhere out there in the future, whether it's a year, 5 years, 10 years, 20 years, there's a slowing of the economy that will likely happen because of the reckoning that will need to be done with our deficit and our debt.
Sure. Okay, thanks, Bernie. Bob, Bobby, I'm going to turn it over to you. Talk us through, we have some risks on here, some considerations on here on the screen. Talk us through these. What's most significant to you?
Sure. There are always risks that we are monitoring in the financial markets and the equities markets, such as stock valuations, potential for speculation in the markets. We're always monitoring those. I'd like to focus more on the ones that are specifically related to the COVID crisis that we're facing and the ensuing recession. With that, Chris, we actually have a chart I'd like to go over, another chart here. And I think this is a really interesting view of what's happened over the past couple of months in terms of stimulus. And that white line shows total personal income, not including unemployment, not including stimulus from the federal government. That yellow line shows all income, including unemployment and stimulus. And you could see where those two where those two lines really start to widen and spread away from each other. And that's there in early 2020 when all this stimulus started to take hold. And you could see how steep that yellow line is now. That is, the stimulus has really acted like a shot of adrenaline for the economy. And the question that's being debated right now amongst policymakers is how much of that is needed and to what extent. And of course, we don't want that yellow line to be close at all to that white line. If it is, that'd be very contractionary for the economy. Again, we were talking about how important the consumer is to the economy. It's important to keep incomes up. The question is, how high up do you need to keep them? How high up can you keep them without putting too much strain on the federal deficit and potentially creating inflationary issues over the long run as well. Mm-hmm. And so that's the debate that we're seeing right now between those. How much do we need in terms of future stimulus? And Chris, if you want to move back to that last slide, those are the two key risks that we see right now. The federal deficit, signs of inflation. Now, having said that, and we've heard inflation calls periodically over time. I mean, the last time we really heard inflationary calls was in 2008 after all of that historic stimulus, and many smart people were adamant that we would see inflation over the 2010s and beyond, and that never happened. And so, Bernie, how does that saying go? Economists have predicted 6 out of the last 5 recessions, and I think a similar. I think it's similar for inflation as well. Not to say that it's very healthy to have that debate and to always keep that as a present thought, certainly in these unprecedented times, but it's also important to be aware of what's happened historically as well.
Absolutely. One of these bullet points on here, weaning the economy off of government stimuli, how hard is that to do?
Right, that's certainly the goal. And again, that's that debate that's happening right now. How much do we need right now? And that number, the total number of stimulus we need will be less and less the quicker we can solve this coronavirus issue and open up the economy. The quicker we could do that, the quicker we can wean the economy off of this government stimulus in a responsible manner.
Okay, thank you. All right, so let's round this episode out. As always, we love to, leave you guys with some action items that you can think about. We can't control what happens in the economy, in the world. We can't control the volatility we see in the markets, but what we can control is how we respond to that volatility and how we prepare ourselves for that volatility as well. So, Bernie, you can go first. Which one of these sticks out to you the most? Which one of them is most significant to you?
Yeah, so Bobby, just a few moments ago, he walked us through a very good assessment of the inflation picture. And, we've seen this before in the past, but, there's a lot of conditions that are being created that are fertile ground for inflation to grow. And inflation tends to negatively impact bond portfolios, particularly those with longer term bonds in them. So if you think about those conditions, if you could, Chris, go back to the income slide.
Yeah.
For just a second, thank you. So yeah, if you look at the yellow line on this slide, that's total income in the United States. On the right-hand side, look how much higher that endpoint is versus the longer-term slope to the left. I mean, that's a lot of money sloshing around the economy, and that's a lot of money that's going to be spent by consumers. That tends to push prices up. If you think about the additional stimulus that's likely to come, I mean, that yellow line is going to stay up there for a while. And then if we get an infrastructure spend by the federal government at all, that's, you know, these are all items that point to potentially higher inflation. Okay, Chris, can you go back to the slide? Thank you. So you couple that with the fact that when you look at the difference today between short-term yields and longer-term yields, well, really neither of them are very attractive. They're both categories are very low, but you're just not getting that incremental benefit to extending your maturities. You're not getting to buying a 10-year bond versus a 2-year bond. You're not getting enough of an additional yield to make it worth the risk, particularly because of these potential inflationary conditions. So we think one of the takeaways from today, one of the things you can do right now to protect yourself, look at your bond portfolios. If you've got extended maturities in those portfolios, I mean, the good news is you've benefited as interest rates have fallen in recent years, but now may be the time to kind of pare those back and look at shorter term bonds, because they will be less impacted by inflation.
Okay, thanks, Bernie. Bobby, you next. Which one of these sticks out to you the most that you want to talk about?
Sure. Well, that second one is very important, making sure that your stock allocation is in alignment with your risk budget. I'd like to spend a little bit more time in that third one, though, the tax planning strategies, especially with current events. We have a presidential election coming up, all sorts of elections coming up in the next 3 weeks. And it's very well possible that if Democrats were to win control of Congress and the White House, the tax code could look different than it does today. So it's very important that sometime between now and the end of the year, you consult your wealth advisor, your tax advisor, estate planner, on any tax strategies that you should be considering, that you should be implementing, that can have a lasting effect in your portfolio.
Absolutely. Yeah, we cannot stress that enough. Use the resources available to you. Talk with your advisor, talk with your CPA, your estate planning attorney, and make sure that all those bases are covered. Okay, I will round us out with my pick, and perhaps not surprisingly, it is the last bullet point: review your plan. For those of you who have tuned into prior episodes, that may sound repetitive, but we cannot speak to this enough. Review your plan. When you put a financial plan together, what you have is intermittent and longer term goals that you can use as your benchmarks. And having those benchmarks, having those goals allows you to keep that long-term mindset when you're putting together an investment game plan and executing that investment game plan. Your investment game plan is literally a catalyst to reach those intermittent and long-term goals. And when you have that long-term mindset, that helps you not make some knee-jerk reactions to events in the economy or, you know, in our country or in the world that you might want to take. So we really, you know, and that's typically something that we caution against doing. And that's not to take away from the severity or seriousness of these events, such as the pandemic or the shutdown. But, you know, the portfolios that we put together, at least, are meant to withstand that volatility, meant to persevere through those events, and typically don't need an overhaul of an investment game plan to get through those tougher times. So review your plan, make sure that those goals are still intact, make sure that those goals and those target allocations are still right for you, and perhaps the occasional strategic or tactical move within your within your portfolio would make sense. And that's where we come in as the advisors. So that rounds out this episode. We do have a few questions already submitted, but if you have any additional questions, please do submit them to the Q&A box. Okay, so we have a question here. Should we consider moving some money into cash now that the market is at 29,000, depending on the individual? That's a great question. Does it depend on the individual? Bernie, Bobby, do you guys want to answer that?
Yeah, I'll start. That's a very good question. We addressed it a bit in the last slide with the takeaways. You should take a hard look at your allocation. I mean, look, we've just gone through an incredibly horrific economic situation that crippled us for a few months, and we are at all-time highs on the market. If anyone would have told you we were going to go through what we've gone through and we'd be at all-time highs in the market, there's very few people who would have believed it, that we'd be here at this point in the year. So yeah, so stock portfolios, which had been decimated, I mean, they're back to full valuation. And absolutely, this is the time to consider trimming. You don't want to consider trimming, in the middle of that turn, when you don't want to slow down in the middle of a turn. You want to slow down before the turn. Particularly for those who are taking income from their portfolio, or particularly for those who are meaningfully above their long-term targets and with stock allocations, this is a time to consider trimming those stock allocations and cash, the cash bucket. That is a worthwhile possibility at this point.
Mm-hmm.
I would say the answer to the question is yes, it does depend on the individual, but this is good timing for that.
Those are great points, Bernie, and I think that's a great question, and I'd like to emphasize that last part of the question, depending on the individual, and more so depending on where your investments are in relation to where your broader financial plan dictates they should be. And that's not just, I mean, we've had so much volatility, historic amount of volatility this year. It's not just during those, but it's when there's a lot of movement, and you should be doing that periodically, checking where your allocations are. A periodic rebalance, again, will get those investments back in alignment with where your long-term goals are. So that's very important to keep in mind.
Yeah, no, the act of rebalancing and having a very disciplined and structured rebalance process and rebalance plan is absolutely one of the greatest things that you can ever do for the longevity and growth of your portfolio. And in all honesty, it may not sound like the most exciting thing in investments or finance. It's not having some sort of intuition about a certain stock that, doubles the week after you buy it. But it's a time-tested, time-proven strategy and method of asset management that, helps with that aim to add alpha in portfolios over time. And it's one of the many reasons, but one of the main reasons why people hire us, is to implement that structure and that discipline into the investment game plan. Great question. Okay, next question we have: how long will it take until we know for sure the effects of the economic shutdown and the pandemic on our economy long term? Do one of you want to take that?
Yeah, sure. I'll start. Yeah, that's a good question. It's a tough question. I think when we look at past downturns, we see that it takes some time to first of all, for the recovery to fully occur, and also for us to understand exactly what happened and what we should learn from the downturn. So this time is probably no different. we're going to need to see some roadway in the rearview mirror to completely understand what happened and also to make our way to full recovery. So it's probably going to be measured in a small number of years rather than months.
Mm-hmm. Okay. Thanks, Vern. You know, that's the frustrating thing about all of this is there's so many unanswered questions and the answer is to be determined, you know, and that's perhaps the most frustrating thing or one of the most frustrating things about this whole thing. You know, time will tell, and unfortunately, patience, you know, is what we all need to have these clear answers. So
you're right, but in the meantime, market at all-time highs. You know, while we wait.
Yeah. So hey, we're not complaining. Okay. Next question here. What are you doing to prepare for the possibility of inflation? Bobby, how about you take that one?
Sure. So we believe the most important thing investors can do to protect against any the risk of inflation is maintain your investment to stocks, stay invested in stocks to whatever amount you and your advisors decide is right for you. So if your financial plan, if your plan calls for a 60% allocation to stocks, and stick with that, because you know, over the last 100 years, when we have seen inflationary periods, time after time, stocks have been the best hedge against inflation, the best protection against inflation. So that's really important. That's the number one thing we would recommend, and we try to preach about is maintain your allocation to stocks. Another really important thing that you can do that we've done here at H&A, Bernie spoke to it just a couple minutes ago. It has to do with the duration of that bond portfolio. So as Bernie explained, a bond with a 3-month maturity versus a bond with a 2-year maturity, 10-year maturity, 30-year maturity. The shorter that duration until the bond maturity, the less of an effect inflation will have on those bonds. So modestly reducing your bond duration, as we have done here at H&A, could be another protection against inflation.
Awesome. Okay. Thanks, Bobby. Okay, the last question we have here. Okay, what, in your opinion, are the most important data points to measure when measuring the economic recovery so far? Bernie, do you want to take that one?
Yeah. So, you know, in the prior slides, we did go through some of the typical, you know, very important data points to measure the health of an economy, you know, whether you're expanding or contracting. Employment, gross domestic product, consumer confidence, business investment, et cetera. These are all important data points, and we need to continue to keep track of how they change, you know, as we recover. But, you know, what's kind of different about this scenario is really there's one data point that we haven't had in the past that we need to pay attention to, and perhaps is the most important one this time around, and that's you know, the timetable to getting an effective vaccine into the market. So, you know, once that happens, all the other data points probably take care of themselves, you know. So that's what's different about around this time around. I think that's what we're all looking for, is the one data point that we can get that will be very critical to determining the future path.
Yeah, absolutely. Okay, I don't see any other questions submitted right now. If anybody tuning in does think of, you know, any questions, please do reach out to us. Our emails are at the bottom of the screen. You can also call us at 412-261-5966. We hope that you will use us as a resource. I do see that a couple people are tuning in. They called in, and again, we will be releasing the recording of this episode on our YouTube channel, and we'll let you guys know once that's available, so you can, you know, watch back with the slides if you'd like. But thank you everybody so much for tuning in today. We'll see you in 2 weeks for another episode of Coffee with Bob. And in the meantime, you know, please do reach out to us, and we'll see you next time. Thank you, everybody.
Thank you.
Thank you.